Welcome to Taking Stock for the week ending the 11th of June 2021, where Jacob Simonsen, our Equities Analyst, and myself, Kien, Trinh, stream to you all things share market. Well, last week we had the pleasure of welcoming Tim Lincoln, our Managing Director and Chief Investment Officer, to share with us his insight into the importance of avoiding speculative stocks, especially at this stage of the market cycle, where many companies with poor financial health and no earnings are trading at elevated share prices. He also reminded investors that technical indicators like the SD Max and SD30 TSR can help trend-sensitive investors manage risk. But remember, using these indicators increases portfolio turnover and tend to only work when stocks have a clear trend.
Yeah, and despite our market now trading well above its pre-COVID levels, we believe that the share market will continue to generate positive returns in the year ahead. This is supported by low interest rates, ongoing stimulus, and the global economic recovery. The vaccine rollout in Australia is also accelerating following the recent outbreak of the Indian COVID variant in Victoria, and we have seen better than expected Australian GDP data over the month. But what has been even more compelling is the trend in corporate earnings expectations for the year ahead.
Yeah, that's right, Jack. The chart on screen compares the All Odds Index, and that's in blue, with the earnings expectations for the market in the year ahead, and that's in black. And the trend in forward earnings has practically moved in a straight line, and it does not appear to be slowing down just yet. This is why it's important for us not to put too much emphasis on valuations at this stage of the market cycle, especially if you are looking at stocks or market PE levels, for instance, because earnings forecasts will continue to change in coming months.
And it's useful to drill into the individual sectors to understand the drivers of earnings upgrades. As you can see from the chart on screen, over the last 3 months, the areas with the strongest earnings revisions have been energy, mining, and banks. On the flip side, there have been earning headwinds in the technology and healthcare sectors, due partly to the strength in the Australian dollar. But with the weak share prices across the tech sector, this has led to a rise in corporate activity within the space. Also, there has been media reports that new investment bank Barrenjoey's are looking to buy up to a 10% stake of Irish shares on behalf of a suspected private equity firm. This reconfirms our view that opportunities do exist in high quality growth exposures that have been beaten down due to the rotation from growth into value.
Yeah, and on the topic of earnings upgrades, Jack, there has also been strong trends in the Australian motor vehicle registrations, partly driven by COVID social distancing measures as people avoid high-risk areas like public transport. And it's also assisted by this instant asset tax write-offs for businesses, as outlined in the 2021 federal budget. And this trend should continue to support earnings for star stocks like ArbCorp, GUD Holdings, PWH, and also Infomedia as well. Also, the general insurers like Suncorp should be indirect beneficiaries from this due to the rising motor insurance policy holders as well. Okay, let's now go into more detail on some of our star stocks. At its strategy meeting last week, Wesfarmers flagged a period of challenging performance as the group starts to cycle through the strong COVID tailwinds of last year. Remember, Wesfarmers, they own retailers including Bunnings Warehouse, Target, Kmart, Officeworks, and also a chemical segment as well. And customers' demand has remained quite resilient, but year-on-year growth has slowed. Even online growth has also moderated as foot traffic to stores returned. So the question this week is, should investors be concerned of the group's negative EPS growth in FY22?
Yeah, this dynamic should not be surprised as 2020 was indeed an extraordinary period, and it would be hard pressed for investors to believe retailers can compound the same pace of growth into FY22. The negative EPS growth is also impacted by higher capital investment into its digital ecosystem over FY22 and FY23. Remember that investment into growth initiatives can make a short-term dent on earnings, but benefit by way of a potential synergies longer term. We are therefore not too phased about the negative 4% EPS growth expected next year.
Thanks, Jack. It's also interesting to hear that Bunnings may launch a side business, and that specifically caters to trade customers. This should help the company capture more of the increasing activity within the construction industry. And aside from this as well, Wesfarmers also has an enviable balance sheet with cash on hand of around 2.7 billion. And this allows opportunities for mergers and acquisitions or capital management by way of special dividends, which should continue to support the current gross dividend yield of 4.6%.
And there's usually a period of share price consolidation after a steep price rally towards new highs. Hence, it may be prudent for investors to take profits and move back to an equally weighted position. Longer term, management have a couple of growth levers that could propel earnings beyond FY22. So any share price weakness in this stock should be viewed as an opportunity.
Another area that we want to touch base on is the resources space, Jake. And copper prices have rallied quite strongly on the back of this global economic recovery. And if you think about copper, it's typically a good proxy for economic growth due to the metal's widespread application in most of the sectors of the economy, especially with the infrastructure and also building and construction sector spending that's going on. Now, we feel copper prices are likely to remain elevated over the medium term as supply of the metal is still struggling to keep up with the growing demand. And this provides some price support for our star copper exposures, Sandfire and also Oz Minerals. But Jake, what are the key differences between the two?
Yeah, so Sandfire is a single mine operator and it's located in Western Australia, while Oz Minerals has multiple assets across both Australia and Brazil. Production-wise, Oz Minerals is targeting copper production that is double and gold production that is 5 times higher than Sandfire's. Also, Oz Minerals operates with a much longer mine life across current operations, and these are likely to be supported by exciting new development opportunities. From a cost perspective, both miners have relatively similar production cost profiles of less than $1 per pound of copper produced.
So between the two, it's safe to say that Oz Minerals is a higher quality play with its larger operating mines and also multi-assets to help diversify production risk as well. Meanwhile, Sandfire's only mine, De Grauser, it has limited mine life, which may explain a decline in the consensus EPS growth expectations in financial year 22.
Yeah, that's correct, Kien. And if a client wants exposure to the global recovery trade but doesn't want concentration risk from a pure play copper miner like Oz Minerals or Sandfire, they can consider a diversified miner like BHP. Copper production is underpinned by Escondida in Chile and Olympic Dam in Australia and represents 25% of revenue for the mining giant. Of course, the bulk of BHP earnings come from iron ore, which represents around 48% of revenue, while the remainder of revenue is generated by the coal, oil, and nickel assets. Turning our attention now to the corporate calendar, Pushpay is expected to host its AGM on Wednesday, the 16th of June. While for trend-sensitive investors, the stocks that turned bearish on the SD Max over the week included AusNet Services, Fisher & Paykel Healthcare. Those that turned back into the bullish zone included Nick Scali and Spark New Zealand.
Yeah, thanks, Jake. And also positively, during the week, Johns Lyng, a building restoration company, they issued a slight upgrade to earnings guidance for FY21. Remember, we spoke about Johns Lyng as a key beneficiary of the government stimulus with home builder and also the public infrastructure projects as well. As a result, earnings growth continues to be in the double digits in the next financial year. This week for Under the Microscope, we want to focus our attention to borderline star growth stock, Regis Resources, a mid-tier gold miner located in Western Australia. The company recently acquired a 30% stake in Tropicana gold mine from IGO and had to raise about 650 million in equity and 300 million in debt. And this, of course, has led to a dilution to its key profitability metrics like return on invested capital. And this stock appears to be underperforming both the gold price and also our other star gold stocks.
Yeah, that's right, Kien. Regis is facing short-term headwinds, including the dilution to its earnings from the capital raise and lower than expected third quarter production update. Along with weakness in the gold price, there has been expectations for flat production and higher capital expenditure, and this is contributing to the negative earnings per share growth expectations in FY21.
And Regis, they definitely look cheap compared to other gold stocks. And it's often enticing for investors to buy into the cheapest star gold stock, though. But we need to remind investors that there are usually good reasons why the stock is cheap. Aside from the increasing risks with the acquisition, Achieving financial year 21 guidance will depend on the continued ramp up of the Rosemont underground mine as part of the Duketon operations. A key overhang on the stock also is whether the McPhillamys development project, whether that will be approved by the New South Wales Independent Planning Commission, which is likely to be in the first half 22 period. McPhillamys is a key growth driver for the stock longer term, but we need to wait on the outcome of its funding strategy and the final feasibility study for us to make a judgment here. Hence, until these key milestones are reached, we prefer Star Gold stocks like Northern Star and Evolution.
Yeah, and we continue to favour Northern Star post the merger with Saracen, which saw the alignment of two companies with increasing production profiles and like-minded management teams. Furthermore, the recent price weakness has allowed investors to enter into a high-quality gold miner that would benefit from rising gold prices and will likely trade on a much higher valuation multiple, considering the large increase to the scale of operations post the merger.
From a portfolio perspective, exposure to gold certainly makes sense if you are worried about inflationary pressures, which is also driving up the price of gold in recent weeks. But remember, since gold is priced in US dollars, a rising Australian dollar can also mitigate the upside potential. But you should also check to see whether the gold miner has hedged its gold prices as well, making it less able to participate on any strength in the gold price. An example of this is Regis Resources, where its hedge position represents a 5 to 10% revenue headwind to the gold price. Over the week, a few companies reported director share sales, including Codan, a maker of metal detection devices, and PWH Holdings, which provides cooling systems for high-performance vehicles. So an interesting question this week is, how do you track selling and buying activity by company insiders on Stock Doctor, and what does a director sell down actually mean? The shareholding of a company insider, like a director and large institution, provides investors with a gauge of how much skin in the game they have. In other words, are their personal interests aligned with yours? In general, investors should look for companies where there is significant holdings by a director or founder, and if there is a large share sale, they should try to understand why. These tend to occur across smaller growth companies.
Yeah, and on Stock Doctor, you can access this information under Golden Rule 7. For example, you can see with PWH there's been a 26% decline in shareholdings by the CEO, Mr. Key Wheel. To investigate this further, you can click onto the corporate details where you can see all the transactions. On top of this page shows a summary of the director's holdings and remuneration. In the case of the PWH CEO, he has been progressively selling down his shares since October 2020. This raises a few yellow flags, especially when the company does not explain why. With regards to PWH, we'll be monitoring this stock closely, but given Mr. Keywheel remains the largest shareholder with a 20% holding of total shares issued, his skin in the game does reduce our overall concerns.
Yeah, and often sell downs are due to tax liabilities as well. For example, in relation to the Codan sale announced this week by CEO Don McGurk, if you drill into the corporate details page, you can see that he was issued shares in relation to his financial year 2020 performance hurdles, and this has created tax liabilities which needed to be settled. And in many instances, the change could also be the result of options expiry or exercise, and usually once options are exercised, they are sold by the directors.
Yeah, other reasons put forward are personal, such as the CEO of Domino's Pizza, where he had to sell a significant number of shares to purchase a house, fund margin loan accounts, and even fund a divorce settlement over the last few years. Other personal reasons came from Altium CEO, who had to sell shares to take care of his parents. Of course, personal reasons are independent of the company's operations and should be looked upon more favourably than those when no reason has been provided at all. Also, it's interesting to monitor the movement of institutional money into the stock. To check the changes in substantial holders, you can navigate to the shareholders icon. From here, you'll be able to see the composition of share ownership and changes to that composition over time.
Often they say you need to follow the smart money, and in this case, we assume it's the institutional money. This can also help you assess the active risks. But due to the lack of information provided by companies on share sales, the best way to analyse their share sales is to combine this risk with other active risks in the company. For example, has there also been management turnover, earnings downgrades, or rising short interest on the stock? All this information can be found on the Stock Doctor platform, and if you have any questions, please feel free to contact our support team. Thanks again, Jake, for your insights today.
Thanks for having me on again, Kien.
So with corporate earnings continuing to rise on the back of this economic recovery, coupled with very low interest rates, we believe share markets will continue to generate positive returns for the year ahead. Remember, don't fear rising inflation because it is a function of economic growth. And just a reminder, as we are approaching the end of financial year, we have a special offer for our new members, friends and family. For existing members, there's also a referral bonus as well. Of course, it is all tax deductible and numbers are strictly limited. Also, the office will be closed on Monday for the Queen's birthday holiday in Victoria. Stay safe, everyone, and have a happy, healthy, and prosperous week.